Well, welcome. Really glad you could all join us for our webinar, Risk and Reward, Post-Pandemic Predictions on Rebounds and Restructurings. I'm Bob Riiska, Managing Director with SierraConstellation Partners. We're a national financial advisory and restructuring firm headquartered in Los Angeles. We have an outstanding panel with us today. We're going to break today's discussion into two parts. First, each of our panelists is going to give their perspective and insight on a different theme. And second, we're going to reveal the results of our attendee survey, which many of you completed. And our panelists will offer their views and insight on the crowdsourced predictions. Questions can be submitted during the panel, and there'll be a Q&A session to conclude the sessions. So I'm going to go ahead and introduce our panelists, and then we'll get started. First panelist is Mark Cronfield. He's Managing Director at BlackRock. Mark is a member of BlackRock's global credit platform within BlackRock Alternative Investors, and he's global head of workouts and restructuring. As a member of the Office of the CIO, Mark helps manage the special situation strategy and associated funds within BlackRock's US private credit group, as well as other credit vehicles. Before his career in finance, Mark was practiced as a bankruptcy lawyer and litigator. Mark is also a frequent lecturer and panelist and author, and he's an adjunct professor, assistant professor of finance at NYU's Stern School of Business, where he co-teaches bankruptcy and corporate reorganization with Professor Ed Altman. Mark's going to be speaking about private credit markets, credit cycle, pre-COVID underlying issues, and other interesting topics. Tom Goldblatt is managing partner at Ravinia Capital. Tom founded Ravinia in 1998, and he has more than 20 years of operating experience in roles ranging from salesperson to CEO. Today, Tom leverages his experience to help company owners understand how to best tap capital markets or sell their companies for the best possible outcomes. Tom earned the annual Distressed Dealmaker of the Year award from the M&A Advisor Turnaround Awards for delivering an exceptional outcome for a company in distress. Tom's going to be addressing distressed middle market perspective and deal flow, and also the middle market outlook for 2021. Reggie Dawson is with Wells Fargo Bank. Reggie is a managing director and division manager in the credit resolution group at Wells. He leads a team of workout officers involved in the management of a portfolio of distressed loans, including the restructuring of credit agreements, implementation of recapitalizations, and both in and out of court restructurings. Reggie has been involved in numerous industries, including restaurants, media, gaming, energy, et cetera, et cetera. Reggie joined Wells Fargo in 1998. Prior to that, he worked at the former Bank Boston, which is now Bank of America, in their asset recovery group and media and communications group. Reggie's going to be covering restaurants update and an outlook from the banking perspective. Duncan Bourne is with Winchurch Capital. Duncan's been with Winchurch since 2003. He brought more than 22 years of consulting and operational experience to the firm, including stints with other turnaround and restructuring firms. He's a certified turnaround professional and a certified insolvency and restructuring advisor. Duncan now has more than 35 years of experience in the turnaround, financial restructuring, and operational performance improvement field. And Duncan's also a fellow alumni of the University of Chicago MBA program. Duncan's going to speak on industrials and manufacturing. So that's our outstanding panel. So on to the panelist discussions, but first I wanted to share one result from our survey. And that's regarding the COVID related question. And our results indicated that our survey responders, the folks on this call, are eager or perhaps at least willing to return to their office and attend in-person events sooner as opposed to later. In fact, 83% of the respondents indicated that, assuming widespread availability of the vaccine, that they would be willing to attend industry events and return to the office before September 30th. As a matter of fact, roughly half indicated that they would do so prior to June 30th. So we have a optimistic, eager group of folks on this call, and that's our audience. And again, we're so glad you joined us today. So without further ado, I'll turn it over to Mark Cronfield, who will give his views as we just discussed. Mark.
Super, thank you. So I think that when we think about where we're going, it's good to kind of level set and also start with where we were pre-COVID, and think about the picture. How we dealt. Where were we pre-COVID? How we dealt with COVID in terms of workouts and restructurings. And then where we stand today, what's changed? What's better? What's worse? What's the same? And what do we think about the landscape looking forward? So, and it was kind of interesting. So what I did before speaking today, I went back to some of the presentations I gave in February, right before the pandemic hit. And I looked at what I thought the state of play was. So, and then I go back and say, all right, well, what's changed? So when we talk about what the state of play was at the beginning of 2020, we knew that global debt was at all-time highs, right? IG debt has grown 3 times over the last 10 years. We talked about how 50% of IG debt was in the BBB category. We talked about how speculative grade debt was a huge high. We talked about how covenant-light loans were 80% of the broader US loan market, compared to 24% just in 2012. We talked about weakening underwriting. We talked about EBITDA add backs. All right, and we talked about the mounting risk, right, with the level of corporate debt in the system. Right? And there were signs of slowing growth and frothy credit markets, yet default rates were only around 3%. Okay, so when we pause there, that's where things were pre-COVID. And what I had always said whenever I spoke publicly on this topic, I said, look, yep.
I'm assuming they're different now, Mark.
Well, it's interesting. We'll talk about what's different and what's the same. But a couple of things. One is that what I always said is, despite the mounting risk in the system and the increasing levels of leverage and the clear increase in risk, the question was always, what's the trigger, right? What's the catalyst to create a spike in defaults, right? Because the default cycle typically precedes the recessionary cycle. And what typically precedes a default cycle is sort of a degeneration in underwriting, okay, when you look at the statistical evidence. And so you can think about it. And again, by the way, what I'm expressing isn't BlackRock's view, it isn't necessarily even my view. It's just an articulation of a view, just to kind of get that. And this is not for attribution, just to kind of get that out there. So the question was, there were people who said, look, this is a pile of lumber with a bunch of gasoline poured on it, but where's the match? What's going to set it off? And so I always said, I don't see, an obvious immediate trigger, absent, of course, some exogenous events. Well, what did we have? We had COVID, right? And one of the things I think that one might think about is, yes, any one individual exogenous event is a low probability, but there are lots of potential exogenous events, right? And so there's a lot of potential black swans out there, any one of which can create a catalyst to light on fire the corporate credit risk that's out there. So we had the pandemic, and what did we see? So what we saw was a lot of workouts and not a lot of bankruptcies. Right? People were unwilling, on balance, to trigger a bankruptcy filing, right? If you're a lender to a company experiencing this sort of short-term effect, even if it was a company that had pre-COVID issues and problems, people did not want to trigger a full-on restructuring, a full-on enforcement of your rights. Why? Well, number one, if you're going to be in a bankruptcy, one of the important aspects of a bankruptcy is the ability to have an auction, the ability to get access to the credit markets for financing, the ability to have potential bidders in 363 sale. But in the height of the pandemic, it just didn't exist. There was a market dislocation. Who wanted to trigger, right, a liquidation, evaluation event at the height of the pandemic, right? So that was one reason for that. The other reason is that many lenders looked at the situation and said, look, this is a temporary phenomenon, right? How do we bridge to a post-COVID universe, which we know is going to happen at some point, despite the overall uncertainty? So we wanted to be constructive lenders, work with our sponsors, and think about ways to simply bridge to that outcome. And by the way, those are opportunities to generate more return, fees, strengthen your collateral package, your structural protections, right? Potentially get equity upside, assuming there's something to bridge to. So you didn't see, unless it was unavoidable, you saw a preference for really having workouts that were constructive and avoiding the bankruptcy filings, right? But just because you don't see bankruptcy filing doesn't mean there isn't distress, right? But people didn't want to trigger that catalyst. Now, where are we? So, and what we saw the Fed pumping an incredible amount of liquidity into the system, okay? So you had fiscal and monetary policy, right? Rising all boats. You had the PPP and Main Street loan programs, which helped facilitate, right, refinancings. So once the dislocation was past us, you had this shortest distressed, cycle in decades. You had a month and a half to deploy capital and make some easy money. Beyond that, things reverted really quickly. And we saw how easily and quickly the government can step in, right, and provide that sort of short-term liquidity and inject that kind of buying power into the market. And that really brought people forward to where we are today. Now, where are we? Well, leverage is increased. It hasn't decreased. People didn't restructure and delever their balance sheets. There were some bankruptcy filings, to be sure, and some restructurings, but on balance, you didn't see a mass deleveraging the way you might have seen after the GFC. What you saw is increased leverage. What you saw are companies, many of which, in order to maintain liquidity, deferred spending on CapEx and R&D, right, to shore up liquidity. You saw people stepping in to provide financing, okay? So where we are today is you have companies with arguably increased risk, if you're measuring it on the basis of leverage, right, and leverage multiples. But you have even more Fed monetary and fiscal support for the system. You have a lot of money coming into the market chasing yields, right? And it has to go somewhere. So yields are at all-time lows. Money is easy to access, and companies have a lot of flexibility, not just because of documents, right? Whether it's up-tiering transactions, holes in documents, covenant flexibility, right? So there's flexibility in the documents to access the capital markets, to cure for short-term maturities and covenant breaches. But what you also have is you have money looking to be deployed, right? And it's cheap financing out there. So the fact is companies have a lot of ability to get rescue financing. And so much of the deals we're seeing, certainly there's a lot of LBO-driven deals, especially with the SPAC phenomenon. But a lot of the deal flow is refinancing deal flow because companies, even with increased leverage, are able to get access to cheaper financing. And people are more than willing to provide that financing because they have to find yield somewhere, right? So there's a view out there that, well, on the one hand, there's increased risk. That risk hasn't gone away. There's more leverage, right? Companies didn't address their fundamental pre-COVID problems. But what it seems to be masking that, that's why you see low default rate predictions and low default rates. And by the way, default rates just tell you about a certain universe of distress, the bankruptcies and the exchanges. But there's lots of distress that isn't captured by default rate. But even distress ratios are relatively low. But is that truly the measure of risk in the system? Perhaps not, right? The amount of expected downgrades, the amount of downgrades versus upgrades are some predictors, albeit lagging. The other issue from the data is that there's a lot of masking of risk by virtue of EBITDA add-backs. When you see leverage multiples, when you see performance numbers, is that clean EBITDA or is that adjusted EBITDA? Is that masking what is true leverage? Is it even worse? But what you still have, despite mounting risk, is you have a lot of bullishness about growth, a lot of bullishness about valuation. People are looking not 1 year out, but 2, 3 year out. These are forward multiples many people are using. So you have this recipe of a multi-trillion-dollar infrastructure program, fiscal Fed policy, and that's sort of buoying everything. And again, we're faced with even more risk, arguably, yet still no short-term catalyst. The maturity wall was pushed out to 2025. So the question is, what's going to put us in the world of, the S&P or Moody's pessimistic default rate? People's, mean default rate, let's say it's 4%, 5%, 3%. But the pessimistic view as well could be 10%. What gets you there? Well, it's going to be exogenous events, geopolitical issues. It could be that people are so pricing things to perfection that any short-term blip could cause outflows. But again, it's you really try. You have a lot of tailwind pushing things forward, and with capital being raised, it has to be deployed, right? That's the nature of the structure. So one thing I'll say finally, and then I'll pause, is that where people are often looking now is to private credit. Because of this thirst for yield, what people are often finding is in the middle market space, in private credit, you're able to get 200 basis points more yield, right? Simply by virtue of an illiquidity premium or a complexity premium. But arguably, in private credit, there's less risk by virtue of the fact that you have better documentation, more control over a process. So you're getting paid more for arguably less risk, although you're giving up liquidity, right, to exit a situation. And that's really sort of a fascinating phenomenon. And the last thing I'll say is we should, rethink what it means to be a distressed investor and where we should be looking, right? It's not just bankruptcy, it's geography, it's municipal deals, it's middle market, it's syndicated, right? It's special situation deals and rescue financing and deal-driven alpha. So I'll pause there.
Mark, thanks so much for your observations. We're going to come back to see what our panel our survey responders said about default rates and get a chance to comment on that. So thank you for those observations. Next, we're going to move over to Tom Goldblatt, and Tom, you're up.
Yeah. Okay. Well, first of all, I think Mark did a great job of kicking us off and covered a lot of ground. I'm going to try to piggyback off that and interweave. And we come from a different perspective. Being a investment bank, we specialize in distressed middle market sales and finding tough to find rescue capital. And goes without saying, and we're sitting here in our homes, last year up to now has been unprecedented. And when the pandemic hit in the US in March and the lockdown began, practically everyone thought that large wave of restructuring work and distressed sales that Mark was talking about was finally at hand. And while over the last decade, since there had been an environment of easy leverage and growing multiples, while before that, 5 to 6 times a company would sell at was kind of normal, 2 to 3 times leverage used to be standard. The valuations going into 2020 had crept to about 8 to 10 times, and leverage was common at 3 to 5 times. And this increase in valuation really kept distress activity to a minimum. It just the companies kept being worth more, and you didn't really need to work out. So that wall of debt they were talking about in like 2013 kept getting refinanced. Starting in March, as Mark had said, it looked like the reckoning was finally here. It was predicted by just about everybody. At that point, the valuations of private companies were expected to go down 30%, and banks began large reserves in the billions against loans. And restructuring thought this is the time, and actually a lot of smart people ponied up. For instance, the restructuring field had its largest growth. It went from, according to Eastward Partners report, about 145,000 to 160,000 just in the couple months in the second quarter. And they had not been consistently busy since 2000, 2005, besides a brief period in 2009. But instead, the amount of restructurings went the other way. And from October to February, commercial bankruptcies were at a 15-year low. Valuations of companies, instead of going down, went up. And at the beginning of the year, PitchBook was predicting, investment banks talking about that 20% of deals would be done at 20 plus multiples. And you can see these kind of crazy valuations in the stock market, but also things like Bitcoin and what happened with GameStop. So why are there so few restructurings? Well, it's a couple of things. Certainly, it's primarily the government support and the Fed intervention. It's what that's done with the values going up. And also, as Mark hinted, there's a reluctance during a pandemic to really take action against a company. Thus, to predict going forward what's going to happen after everybody was so wrong, I was so wrong, takes a lot of hubris. But we'll give it a try. I'd say that the biggest lesson coming out of this is just how uncertain the future is. And so when will there be a wave of restructuring? Well, the goalposts keep moving. Last summer, the common wisdom was that after the end of the year, banks are going to start working out lots of their credits and there's going to start to be a lot of transactions. Then the fall came and people saw there's going to be more government help. The pandemic is going to go longer, and people started saying, well, it's not going to happen until about August of 2021. And now people are starting to say, looking at what the Fed is saying about interest rates and other things, it's not going to be until like 2023, if ever. The main thing is the next large wave of restructurings will not happen until the market thinks that interest rates will rise materially, which will lead to money going out of equities and a corresponding reduction in the valuation on multiple rates. The Federal Reserve is saying that they will not raise interest rates until sometime in 2023 or after. However, if the market senses that that there's a certainty that they are going to raise rates, the equities will begin to react because they are forward-looking. It'll be an interesting summer this summer, particularly for macroeconomic fans, because the growth expected to be over 6%. This is due to people being vaccinated. People are ready to get out there and spend money and party. There's pent-up savings and demands, and there's all that stimulus money sloshing around. The Fed is saying that they plan to hold steady, and even as things start to accelerate, to hold, and because they see this as a one-time boom. There's a lot of debate out there about whether the inflation's coming. I personally think that for restructuring deals, restructuring professionals, that we're going to see a pretty solid pickup in work starting this summer. I think once the pandemic's over and a lot of people's PPP money and others have run out, there'll be a cleanup. A lot of people will be focusing private equity funds in their portfolio on their better deals and ready to kind of move away from their past. But the real wave, the wave that people have been talking about for a long time, probably won't happen until 2023. But really, nobody can predict it because it's really based on herd mentality. And as soon as there's a strong whiff that values are coming down, there could be a sudden shift. So that's
Tom, if I may interject, those are very, very good observations. If you could just give me a brief response on your thoughts on if you want to sell your business or you're an advisor to a company at this point, do you hold off for a bit or for a return to normalcy, or do you go ahead now and explore your options at this point? And if you give me a brief answer, then we'll move on.
Now is a great time to sell your company. I think that there's the valuations are definitely at super highs. Nobody can argue that. Will they last longer? Nobody really knows, but you do know that they're at highs. I think people are able to kind of make adjustments for EBITDA, earnings before interest, depreciation, and COVID. And also with the tax bill that's supposed to come up, that's a pretty likelihood. This is a good year to kind of, I think, sell your company. So I would highly recommend, you probably want to start the process soon so that you can have it done before December. So I would say now is an excellent time to sell a company.
Excellent.
Hey, Bob, so what we're seeing in our deal flow is businesses that did well through the pandemic are for sale, and they're getting sold at very high prices. But a lot of businesses did not do well in the pandemic, and they're being held back by their owners because their owners want to see them recover to get back to a supportable EBITDA.
Yep. Thank you, Duncan. Well, thanks, Tom, and thanks for your comment as well, Duncan. We're gonna move on next to Reggie Dawson, who's going to give us some overview on the restaurant industry and some other stuff. Reggie, all yours.
Yeah, sure. Thanks. Thanks a lot, Bob, and Mark and Tom did a great job, obviously, of covering things on a somewhat macro basis. I wanted to maybe drill down briefly a little bit on what we've seen inside a commercial bank with some of our restaurant clients. I mean, we are along with a couple of other banks, one of the larger, lenders, in the space. And going into the pandemic, there were a lot of predictions out there of anywhere from 25 to 35% permanent closures, in the restaurant space. And as a result of that, even within our group and within some other banks, within our bank and some other banks, we brought over folks to focus on restaurant workouts specifically, as we've done and others have done in other industries, real estate, energy, et cetera. What we have seen, and what one research firm, Data Central, is reporting recently, is that in fact there's only been maybe 10% permanent closures. They're reporting 79,000 restaurants permanently closed since last March, of roughly 800,000 full service restaurants. And obviously that's a big number, and it's devastating, but it's half or less than half in many cases of what many had predicted. Conversely, revenue wise, I think there was a pretty much a widespread prediction of 25 or so % declines in revenue amongst the full service restaurant space. And recent reporting on those figures through 2020 show, in fact, restaurants did suffer roughly 20-25% declines, in revenue. So sort of similar to, why did we experience, bank restructurings, but not bankruptcies, or maybe not even the levels of restructurings we expected? Why not the same level of restaurant closures as expected? Well, there's, a number of factors, some of which some of the guys have already covered. But one, obviously, PPP was huge for the restaurant space. There's numbers thrown out that anywhere from 35 to 50 billion of PPP funding went to the restaurant and hospitality spaces. And for those restaurants that weren't able to participate in the first couple of rounds of PPP funding, the American Rescue Plan is setting aside even more money for those firms to be able to tap into, to keep people employed and to support their liquidity. The other thing.
Can I ask you a question? You mentioned the effective PPP loans, but I was just curious. Do you have any interesting stories related to how borrowers fared better or worse than others in the industry? PPP would be one, I'm sure, but
yeah.
Anything else?
Well, there's a couple of interesting things. One, I think, who would have known how valuable it is to have a drive-through window, if you're a restaurant operator. But the quick serve segment has fared extremely well. We have some quick serve franchisees that have actually seen same store sale growth during the 2020 calendar year, and that's with basically no dine-in capacity, whatsoever. So the performance of the quick serve business has been a pleasant surprise for for us from a lender standpoint. The one funny anecdote we had, the one funny story is I had one borrower that actually had pandemic insurance, and they were able to collect over $1 million from their carrier because they actually had pandemic coverage that the insurer could not deny. I think there are many companies that try to file claims for revenue loss unsuccessfully. So my hat was off to this particular CFO. Their insurer quickly dropped that coverage when the policy came up for renewal, so it was a one-time deal. But that was kind of one of the more interesting things, and they're actually one of the more innovative companies I've seen, in this space during the pandemic.
Well, that's certainly, kudos to them for having that. Has the banking industry handled this, distressed credit issues differently this time around?
Yeah, I think most definitely. I think for one, as Mark mentioned, this was more or less, where everyone, the workout cynic in me said everyone was treated as a fallen angel, or many companies were treated as fallen angels. So a lot were pretty much given a pass, from the standpoint of getting, a covenant holiday for multiple quarters, interest deferrals, principal deferrals, which is something that is, pretty much unheard of in the banking business, to allow borrowers to go a quarter, 2 quarters, without servicing debt. But that's something that was offered to companies across multiple industries.
Bob, one thing I would add is that one important distinction between what we saw in 2020 and what we saw, for example, in the GFC back in 2008 is the nature of the participants in the market. Back in 2008, you had a lot of hedge fund participants with quarterly redemptions, a lot of sort of fast money that can go in and out. This time around, you see a lot more participants with fund structures that are 7-year funds, locked up capital, BDCs with permanent capital, where you don't have the pressure of redemptions and forced selling as a result. So people have the ability to kind of ride temporary troughs in valuation, and because that's really what we saw last time, which is forced selling and this sort of downward spiral. So I think fund structure and sort of the stickiness of capital is an important feature to avoid sort of forced selling in sort of cataclysmic scenarios.
Thanks, Mark. Reggie, any last brief comments on the observations before I turn it over to Duncan?
No, just a couple other points, specific to the restaurant space, and Duncan's, firm, operates within this space. So, he'll just poorly vouch for this, but, the, landlords obviously played a role in, reducing, I think, the amount of permanent closures in that, they granted multi-month, rent deferrals, which ultimately, the restaurant operators have started to repay in many cases. Some have already, brought their landlords current. But certainly at the peak of the crisis, that provided operators with additional breathing room. So along with, PPP funding, bank, covenant and debt service waivers, contributions, from the landlords, obviously were big in keeping the industry afloat.
Great. Well, thanks for those observations, Reggie. Really appreciate it. And now I'll turn it over to Duncan.
Thanks, Bob. And, sort of following up a little bit on what Reggie had to say about restaurants. I mean, last year at this time, early April, stores that were still open, they were experiencing 75, 80% downturns in activity. People had gone to the grocery store and purchased a lot of goods, and they were sitting at home scared to death of going outside, getting sick from COVID. Instead, they're staying home and eating, and they wouldn't touch anybody or anything. It's amazing what the restaurant industry's done in the last year. Touch-free service, all throughout the retail sector, all the different things that have been done to accommodate, changing consumer preferences. It's amazing how fast industries can change. And PPP was certainly a masterstroke of keeping these businesses in operation. I think we would have seen tremendous damage in our economy if PPP hadn't been enacted. It was a pretty smart thing for the government to do. So I'm just going to talk a little bit about what we're seeing in the manufacturing space. Winchurch is pretty much an omnivorous investor. We like situational investing. We tend to stick with industrial and manufacturing type businesses, though we're involved in the real estate in the restaurant business, for example, because it was a distressed debt situation that we were able to get involved in and bring in a new management team, take the company through bankruptcy and get the business back on its feet again. So it's been a lot of fun to be involved with that. So in the manufacturing industrial space, echoing what I think everybody has heard thus far is that last year was an amazing period of time. The first couple 2.5 months were great, and the whole industry is sort of coming off of a soft 2019, but things were pretty stable in early 2020. We were getting over issues with tariffs, but then China started to have logistics issues. And actually, a lot of the issues that we experienced in the first half of last year were logistics from China, parts, raw materials, et cetera, was not coming across the ocean because they'd been shut down. I mean, China's first quarter last year declined 12.5% in manufacturing production. That's compared against a usual anticipated 6% increase in manufacturing. So it's like a 20% reduction versus expectation in the first quarter of last year. And so that was a big deal to go through. Then, of course, everything shut down. Government, various governments around the country, states, municipalities, et cetera, shut down businesses, hard shutdowns. People couldn't get to work, couldn't do anything, couldn't make anything. So everything was shut down there for a while. But then as soon as things started to open up, I think we all saw it in the middle of summer, things really got going. And then the issue was, again, factories been shut down, couldn't get things that you wanted to get together to put things together. You couldn't assemble an RV, for example, because you couldn't get a stove. And funky things happen in the economy. In my lifetime, RVs were always the indicator of bad times. I mean, driving past the RV industry here in northern Indiana all the time, you'd see RVs parked out there in lots like crazy. Not this time around. RVs bookings are at like an all-time high right now, and they're working off a tremendous backlog. It's amazing how different last year was for so many industries. Boats, people are buying boats out the wazoo, and that's not typically a recessionary product. So, but a lot of production, a lot of goods manufacturing last year was constrained by these sort of logistics issues that I mentioned. And a lot of dislocation persists today. Logistics is still a big challenge. It's very difficult still to get things on time. We're seeing in our manufacturing businesses difficulty getting things from overseas. However, that said, boy, does 2021 look like a great year. The manufacturing indexes are up quite substantially. ISM, the Institute for Supply Management, said last week that Q1 manufacturing grew at the fastest pace in 37 years, and that their purchasing manager index right now is 64.7, which is the highest since 1983. So there's obviously strong demand as the pandemic is easing off, and that people are getting more tired of it. And I think government stimulus is flowing into the economy. And I think also pretty much that in the short run here, it's about vaccinations, getting those deployed. And as soon as everybody figures out how to get vaccinated, that they get vaccinated and they figure out how long that's going to last and their confidence with respect to their health, I think you're going to see not just manufacturing recovering, but you're going to see a lot of travel, hospitality, dining coming roaring back. And you're already seeing it in the jobs data. Million jobs created, I think it was last month, 900,000 created in March. 2/3 of them in the restaurant or hospitality sector, or travel sector. So significant growth in those sectors is coming on. So I think on the deal side of things, Tom was talking about that before. We're seeing very high prices on the deal side. Mark spoke to it as well. There's a surfeit of capital availability, businesses that performed well. It's funny, going back, as Mark talked about, going back pre-COVID, the sort of recession-proof businesses back then were also getting sold and also commanding high prices. And we're seeing that again through the pandemic. Now these are businesses that are absolutely proven recession-proof, and they're going for high prices. So that's sort of a really quick nutshell summary of manufacturing industrials from me.
Oh, we really appreciate it, Duncan. And I certainly observed the other day all the container ships lined up outside the port of Long Beach, waiting to dock and all that. And it seems, again, there's supply chain disruption. There's all sorts of stuff happening, but it's sure going to be an interesting year. So thanks for those observations.
Yeah.
So at this point, we're gonna move on to the second part of our presentation, talking about the survey results. We're going to put something up we're going to put up on the screen. Thank you. And if you next. Again, the answers to the surveys were optional, and about 100 people did reply with their predictions from 11 different industries, 78 organizations. So I think we got a really good breadth of responses. Next. So we're going to talk about some of these results. We're going to focus on 3 or 4 of them and move through the other ones in the interest of time fairly quickly. But the prediction of our respondees for the S&P 500 index is 3,991 for the end of the year. As everyone knows, it's been on a little bit of a mini tear, a few percent over the past week or so, and we're above that. It seemed that the 4,000 level was a factor in our respondees' views. I'm just curious if Mark and or Tom, if you have just a couple of brief observations on that.
Well, I would say all the answers might be right before the end of the year. You know, it's really hard to say because certainly earnings are going to go up, as Duncan we're about to see a boom. But the question, the valuations versus historical, PE ratios, technology are like in the 30s. You've got these SPACs going and in the 20s. When we, back when I went to college, it was like the average was always said to be 13, and that was an average, meaning that when it's 20, it was another times 6. So is it baked in? But I think, like Mark was talking about before, we might see where there's a reaction where people think that the interest rates are going to go up and the money flows out, and then maybe it will flow back in. So I think it's going to be very volatile, but we'll see.
Great, thank you. Thanks, Tom. Next, we'll just quickly review this. The 10-year Treasury Note, that's something yield that's also been in the news. It was below 1 back in December of 2020. It's increased to about 1.7% as of now, trailed off a little bit. Again, moving around a little bit. Our attendees projected increasing to 1.9%. Anyone have a brief observation on that?
A lot of this is driven by Fed policy, and so it's hard to predict, but I think that it's going to continue to increase. There's starting to be some worries about inflation and things like that. We'll see if that, I don't know how long or far off that is, if it ever comes to pass. I mean, people warned about it during the Great Recession as well. But I think it could go higher, over 2%.
Thanks, Duncan. Next. None of us, to my knowledge, are oil and gas experts on this call, but so it may pass through this one. But the Brent crude oil price was $64 as of March 19th. Our survey responders are predicting it will increase to about $67 by the end of the year. Again, certainly, does anyone have a brief comment on that before we move on?
Just as someone that's done, a fair share of E&P workouts, it seems that, this is one, once that number starts to creep up, you start having a lot of investment in independent E&P producers. So to the extent we want to look for our next restructuring opportunity, let's root for further increases in that number, because that'll certainly attract some bad investments and create some workouts for us.
It's funny, Reggie. I spent I don't know how many years looking for deals in the oil and gas space, various types of businesses. It's so cyclical. It's so hard to be we're a leveraged buyout fund. It's so hard to be that kind of an investor in the space. You need to have some cash on the sideline for those downturns, pick up assets when they're cheap and sell them when oil prices are high.
Absolutely.
I think we're sort of in a range of oil prices.
It's based off of two things. It's based off of the expected production around the world, which should boom. So we should see that go up. But it's also based off of the dollar. It's dollar dominated. And I think that with all this money coming in, and we're already seeing the dollar depreciate, so there's a good chance. But I think the dispersion in all these things just show the uncertainty. And who remembers back in April when the price of oil went to negative 25 or 30 for a brief day?
Right, exactly.
Whoever said 109 is obviously an oil and gas lender, though.
Right,
Every
exactly.
time that stuff just keeps on coming out of the ground, you got to put it someplace. So that's why I got the negative value.
Right. Next. Unemployment rate. In the interest of time, because we do have some good questions from the attendees that we want to make sure we leave time for. So we'll spend a little time on the unemployment rate, and then the next one, which is bankruptcy filings, and then we'll probably move on to questions. But as far as the unemployment rate, I mean, the U.S. unemployment rate fell to 6% in March from 6.2% the prior month. It was the lowest rate in a year. There were 916,000 jobs added in March. As a point of reference, the pre-pandemic comparable rate was 3.5%. So our survey respondents are projecting that the rate will decline only fractionally down to 5.6% by the end of the year. Curious if our panelists have views on that.
I think. Go ahead, Reggie. Go ahead.
No, I was just going to say, prior to hearing Duncan's earlier comments, I would have agreed with that. But being that he's an investor in spaces that are active employers, it sounds as if maybe he's thinking that number will come down.
Well, and I don't know. It's hard to say. I mean, the unemployment rate it's kind of a weird number, right? Because it's percent of people looking for work, right? But if you look at where we're at in employment, March 21 was 139.2 million of non-government, non-ag employment, and in January of 2020 it was 147 million. So we've got a lot of slack still to pull on this string as far as us being at a full employment economy still. So we got a ways to go yet. But about the rate itself, who knows? It depends on who's looking for work and who's interested in working and things like that.
I think there's two components to this as well. You've got all those people that are involved with entertainment and hospitality that lost their jobs immediately. A lot of those are going to come back, and it's going to be a great summer. You also, though, have a longer term trend that I think we're going to see more of, and just in how we're talking over Zoom, there's just been a lot of efficiencies in work. And the question is whether some of these are permanent job losses or will come back. I think that those are two different elements to that.
And that's where my thinking was, Tom. My thinking is that, some of the companies that I work with, I think they are going to be reluctant to give up, some of those efficiencies and to rapidly increase their payrolls. I mean, obviously you're also, dealing with wage payroll increases across a number of states as well. So I think there's going to be some counterbalancing pressures on that number.
Reggie, you just brought up something that's been in my mind a little bit, and that is, we've had a very brief recession, right? In terms of time, there hasn't been that much time for wage reset like we typically have in longer recessions. You saw that in the last one where there was a fair space of time where wages got cranked down a little bit, but that hasn't happened this time around.
Mm-hmm.
Thanks, Duncan. Next. Let's talk about commercial business bankruptcy filings. And after this, we'll quickly go through the other predictions. And then we do have some great questions from the attendees. So I want to make sure we get to at least a couple of those. So commercial bankruptcy filings, although the headlines this week might state that March 2021 bankruptcy filings were the highest level in 12 months, those are really predominantly non-commercial consumer filings, which jumped 41% over the prior month. On the flip side, commercial Chapter 11 filings were actually down 9% from February at 384 for March, and are now running at a pace 25% below last year for the first 3 months of 2021. I'm curious what our panelists think of the outcome. Our attendees predicted a wide range from a low of 2,500 to a high of over 10,000 with an average of 6,462. So I'm curious to get some brief comments from our panelists on their thoughts.
Yeah, I mean, from my perspective, directionally, I think you'll see fewer Chapter 11 bankruptcy filings than one would otherwise expect. There's really, maybe you'll see pre-packs, but there's really no need for it. you have the liquidity and you have the mechanisms for companies to avoid the need for a bankruptcy filing by accomplishing their goals outside of bankruptcy. So it's really, bankruptcy is going to result from either the inability to deal with the problem outside of bankruptcy, right? Inability to herd cats and to come to some consensual resolution, or the need to use bankruptcy as a mechanism to accomplish your goals, like reject leases, things like that. But for the most part, what we've seen is the ability of companies to have flexibility to access capital to avoid payment defaults, which will lead to the bankruptcy. You're seeing an overall, drop in default rates. So, the companies simply don't need it. So yes, you'll continue to see some in the energy space and perhaps some in the businesses that were most affected by the pandemic, such as restaurants. But overall, your companies just don't seem to need to access the court system right now, on balance.
There's been such an increase in lending, and then there was a lot of risky debt put out there, and then a lot of people felt the Fed was backing up everything during June. So I think when we come out of this, I agree with what Mark's saying, but I think we're off a low base, and so I think that when it kind of gets to the end, I think there's just going to have to be some unraveling. It's not going to be exorbitant unless the markets come down a lot and values come down, but I think there's just a lot of debt and some of these companies over borrowed, and that's going to need to be worked out.
Yeah, and the real question is, obviously this is 2021, so it's still short term, but if the default rate is expected to be 3%, 4%, 5%, and then you have even fewer people who, even where there's a default, need to go to bankruptcy court to resolve it, what's going to drive the bankruptcy filings? But in the medium term, it's a very different story.
And subchapter 5 just got extended, which allows the new small bank with the easier rules. I think it's up to 7.5. It might be 10 million, and that should take care of a bunch of stuff.
Yeah.
Great. Thanks, Tom. Thanks, everyone. Next. So these last three, we'll go through just quickly here and then get to a couple of questions from the audience because they're really good questions. High yield bond trailing 12-month default rate. This rate was, to give a point of perspective, was only 2.9% in March 2020, peaked at 5.7% in this past August, and now has been dropping down to 4.9% in March. Our survey respondents predicted, increasing slightly up to about 5.6%. Next. Leverage loan secondary market weighted average bid. This measure actually, going back to when COVID hit, was 81.1 in March of 2020. It rose each month up to 97.02 in February, and then it dropped slightly to 96.79 in March. Our panelists, our survey responders are predicting it's going to stay at about 96 going forward, but you can see how far we've come from March 2020 in terms of how the secondary market is doing that. And then the last prediction, if you get next, please. And this would be a topic in and of itself. Perhaps we can have another webinar and cover this one in great detail, but it's always hard putting a number on enterprise value, multiples of EBITDA. We're currently at 9.7 according to one measure. Our responders predicted staying at 9.7 with a range of 7.5 up to 12.2. Again, a lot of that is determined based on the size of the companies looked at, all sorts of other variables. So I know everyone would love to talk about this. We'll have, I think this, perhaps another webinar we could do that. I'd like to just turn over to a couple of questions from our attendees because we've had some really good ones. One question, and any panelists jump in, please. There was supposed to, one of the attendees says there was supposed to be 400 billion in distressed CRE hitting the market in Q1, Q2, 2021. There's some pockets of distressed in CMBS collateral, but I see little elsewhere. Do you expect distressed CRE to hit in 2022? And what is your best estimate to the size? Anybody want to touch that?
Well, I think it's going to be quite large. I think that's an area that's got fundamental change, and I think that, office buildings and stuff are just not going to have the same type of demand. There's going to be a lot of space. And I think that is right. If you look at what happened in 2009, it kind of got worked out over 3 years. So I think we'll see a lot. At Ravinia Capital, we've just added some workout real estate people because we're anticipating that there will be a large wave of real estate workout, particularly in the office sector.
Yeah, I mean, the Journal had an article yesterday that said that there's just on Q1 information that they were privy to, that they had prepared for them, that 13% average rent reductions based upon actual rental rates and also free rents being given. 10% average space reduction so far requested. I mean, here in Chicago, the sublease space is the highest, is higher than it was in the last downturn by a lot. And it's over 3% of total rentable square footage in the city. And it's 2/3 of it is Class A office space. It's not the Class B or C stuff. So this is just the beginning. And then firms are just getting their heads around where they're going to be. You saw Boeing is going to, reduction of its workforce. That office has got office space up for sale in Washington. And so, I think that it's just beginning. And we'll see also that the pandemic taught a lot of businesses how it's less expensive for people to operate out of their homes and also less expensive for them to travel. So I think you're going to be seeing permanent dislocation from what we've historically experienced. I think Tom's right.
And far less hit on productivity than people probably thought. In fact, people worked even longer hours.
Absolutely.
Yeah.
Right.
Yeah, but you don't have to drive to work. It's like a vacation. You're not driving to work. It's great.
Well, and we have time for one more. I'm looking at two questions that are pretty similar, so I'll try to combine them into one here for the panel. But essentially, it's does anyone see major changes creating during the pandemic as remaining these changes in consumer behavior? In other words, additional services that arose, thinking about massive deliveries of goods, food, etc., car dealerships picking up your car, servicing it, returning it to you. Do you view these as permanent changes?
I can say right now we're working on a capital raise for a vacation home rental company and they had a terrible year, and now they're seeing a surge in bookings. And so I'll put it out to the people out there. If somebody's interested in minority investment in that industry, contact me.
Great, thanks. There's actually one more question I'd just like to cover quickly, and then we'll call it. So how would you expect a black swan from outside the U.S. to impact the Fed's ability to control future GDP loss?
But that's a tough one. We've got our own kind of currency that we can control, and the Fed has a lot of power, as evidenced in this last pandemic, to keep our economy afloat. It's hard to say. Look, we saw it in the last recession too, guys, where the Fed got going in the spring of 2009, made easing take place. It probably wasn't enough of a stimulus back then, but it had a dramatic effect. So I think that they've learned their lesson on how to work through recessions better. So I don't know the answer. I don't know if there is one. Don't know.
That's the right answer. Nobody knows.
Nobody knows, right?
Why is it black swan?
Thank you. Well, with that, I'm sorry we weren't able to get to all of the questions submitted, but really appreciate everyone taking their time. So I do want to thank our panelists for participating and providing their carefully considered views and comments. And I also do want to thank our survey respondents for taking the time to give their thoughts. We really couldn't have done this without you. And all the attendees, again, really appreciate you joining us today. We hope you took something away from today's webinar and look forward to seeing you in person soon in this hopefully post-pandemic world. We'll be posting this webinar on the SierraConstellation website, and I hope everyone has a great rest of the day. Thanks so much.
Thank you,
Thank you,
Bob.
everyone.
Thanks for your staff.
Thanks,
It's very
Bob.
professional.
Take care.
This is a lot of fun.